All right, let's talk about something that could be a total game changer for you real estate investors out there. It's called DSCR 2.0, and honestly, it's a modern funding pathway that's all about one thing: growth. If you've been looking for a smarter, way faster way to scale your portfolio, then you're going to want to stick around for this.
So, let me ask you something. Does this sound familiar? You find an amazing deal, you pour your time and money into it, you get it fixed up, and then what? You're just stuck, right? You're waiting for that capital to slowly build back up so you can go find the next one. Man, that one deal at a time grind, it feels like you're just constantly hitting a brick wall. Okay, but what if? What if you could flip that script entirely? Instead of all that friction, you could have momentum. I'm talking about building a system that literally fuels itself, letting you just roll from one property right into the next. That's the whole idea we're diving into here.
And that system, well, it's got a name. We're going to call it a smarter funding pathway, and we're introducing the DSCR 2.0 strategy. This is an approach built from the ground up for investors who are just ready to move faster and build a whole lot bigger. So what in the world is this DSCR 2.0 thing? Let's get right to it. Think of it as a two-phase system. You acquire a property, you rehab it, you refinance it, and, this is the key, you pull your equity back out. Why? So you can turn around and do it all over again, and again, and again. It's all about creating a cycle for rapid growth.
All right, let's pop the hood and look at the blueprint. We're talking about how to build your very own funding engine. And it's really built on two super distinct, really strategic phases that work together to create that momentum we were just talking about. Okay, so phase one is your sprint. It's all about acquisition and rehab, and you're using a short-term bridge loan to make it happen fast. Think of it as your get in, get it done stage. Then you shift gears to phase two. This is your marathon, stabilize and refi. Once that property is fixed up and has a tenant, you refinance into a long-term DSCR loan. And here's the magic. This loan is based on the property's income, not your personal tax returns. This is how you lock in that sweet, sweet cash flow for the long haul. And here it is, the whole repeatable cycle laid out. It's beautiful, isn't it? You start with that bridge loan to grab the property. You do the rehab, you get it re-rented, hopefully at a higher market rate. Then comes the reappraisal. Boom, higher value. That new higher value is your golden ticket. It lets you do the DSCR refi, pull your cash back out, and here it is. The best part, you take that cash and you repeat the whole thing on the next deal. It's a rinse and repeat formula for growth.
So when you're in phase one going for that bridge loan, what do the lenders actually care about? Well, it's pretty straightforward. They're looking at the deal itself, what's the purchase price, what's your rehab budget look like, and the big one, what's the after repair value, the ARV going to be. They're also going to want to see a solid contractor bid and a clear exit plan. Basically, they just need to know you've got your ducks in a row.
Now, when you move into phase two, the refi, the whole game changes. The new king of metrics is the DSCR, the debt service coverage ratio. All that is really is a simple check. Does the property's rent cover its own bills? Lenders want to see a DSCR of, say, 1.2 or higher. That just means the property is bringing in 20% more cash than it needs to pay for everything. It's proof that the deal works all by itself, without you propping it up.
Okay, so at this point, you're probably thinking, wait a minute, this sounds a heck of a lot like the classic BRRRR method. And you know what? You're not wrong. It's definitely a close cousin. But there are some huge differences that give DSCR 2.0 a serious competitive edge over the traditional way of doing things.
Let's break it down. The absolute biggest advantage here is speed, pure and simple. The DSCR 2.0 pathway is just faster. Why? Because the paperwork is so much easier. Think about traditional BRRRR. You get totally bogged down in providing personal tax returns, verifying your income. It's a nightmare, especially if you're self-employed. But with DSCR loans, the focus is on the property's income, not yours. That makes getting that final long-term loan so much cleaner and way, way faster.
Okay, this all sounds great in theory, right? But now for the big question. How do you actually put this into practice? And maybe even more important, is this the right path for you?
And let's be real for a second. This strategy isn't for everyone. It's not a one-size-fits-all solution. It's a very specific tool for a very specific job. So you've really got to ask yourself if your investment style and your goals line up with what this model is built for.
So who is the ideal candidate for DSCR 2.0? Well, it's for the investor who loves the hunt, right? The person who's always looking for those value-add deals, properties you can snag below market value and force appreciation on. If you're the kind of person who wants to scale and scale aggressively, and you're just plain sick of jumping through the hoops of traditional financing, then yeah, this was pretty much designed with you in mind.
All right, so if you're thinking, yep, that's me, then let's talk about what it actually takes to get the green light.
Here's what you need to know about the underwriters. They need to see a story that makes sense. The numbers have to connect logically from start to finish. That means you need to bring strong comps to back up your ARV. You need realistic rent projections for that specific neighborhood, and you need a tight, clear timeline. We're talking 3 to 6 months to get that property turned around and rented. And look, let's not forget, your own stability, your credit score, your cash reserves, that stuff still definitely matters.
And at the end of the day, it really all boils down to this one idea: scale smarter through structured funding solutions. It's not about working harder. It's about having a system, a deliberate, repeatable, and seriously powerful way to build your portfolio.
So as we wrap this up, I want to leave you with a question. Now that you know about this powerful, more efficient funding pathway, what's the next deal this could unlock for you? Seriously, what door just opened up in your mind?